Good day, ladies and gentlemen, once again. I'll be now recording this question 5. Company name, Bluebags Pty Ltd, 28 marks. The marks allocated for this question. Now, we, as usual, begin with the requirements. I always advise to start with the requirements. However, if you like to start analyzing the information, that is still not a problem, but my approach is that of the requirements so that I know what is required, so that as I am analyzing the information, I know that this information is applicable on such and such a question. Now, it says we are required to calculate the following based on the above variable costing system. The company is using a variable costing system. Remember, it can be a variable costing system or it can be absorption costing system. Variable costing system sales minus variable costs, then that will give you contribution. However, the absorption costing says sales minus cost of sales, that will give you the gross profit, meaning the absorption costing system includes fixed cost or fixed production cost in the calculation of the cost of a product. We are then required to calculate the sales mix variance. I want you to underline the word mix specifically, sales margin mix variance for the 6-month period. Why am I highlighting that mix? It is because in the latter question that I did, the company name called Dazzle Ltd. Dazzle Ltd, we were there required to calculate the break-even point based on their standard product mix. If you remember that question, if you have listened to it, based on the standard product mix. So now we explained what does that mean. By taking our sales units that we budgeting to produce and sell, we look for the common lowest denominator, which was 5:4. So now under our sales mix, we also need to know that sales mix. Then after, it says our requirement number 2 is to calculate the sales margin volume variance for the 6-month period. Then the last one under 1 is the material price variance for the 6-month period, and it's a total of 12 marks. Then after, there's a theory aspect of the question, which I will not be doing it, number B. Then after, we have number C, where we are to calculate based on the budgeted figures, calculate the budgeted break-even sales value. If you see now, this is different from the previous recording. Once again, the company name called Dazzle Ltd. This is the sales value. That means we don't end with the units. After we've done the break-even point units, we need to multiply it by the selling price. We get to the sales value that of the break-even point, meaning the revenue that the company will receive when it is at the break-even point. Then once again, if it was the contribution at the break-even point, sometimes they can say calculate the contribution at the break-even point, meaning you need to calculate the break-even point units, then you multiply it by the contribution. Remember, contribution, it is the selling price minus all the variable cost. So this is exactly emphasizing now or doing what I highlighted previously. Then let us now go to the second requirement of number C, where we are required to calculate the break-even point in units, which is sales quantity for the handbags product for 6 months, which is only one product, for the period based on the following assumption that by the end of March 2014, the sport bag line was discontinued and the standard material purchase price per meter was adjusted by 10%. So now we are doing here the break-even point only for one product because the other product was discontinued in terms of operation or production, and the material requirement per unit was adjusted by 10% of the remaining product, which is the handbag. So the material requirement went down after the discontinuation of the other product. So now we need to take that into account and calculate the break-even point only for one product. Only 3 marks. There's not much to do in this last question. This one is just the theory on the use of the absorption costing system and its effect on the sales margin mix variance. And then we also need to show the calculation when it comes to that, but I will not be doing number 2, only one, which is number A and number B. Now it says question 5, Blue Bags Pty Ltd. We can say that this company is likely to be producing bags. It says the Blue Bags Pty Ltd. manufactures and sell two types of bags, the handbags and the sport bags. They have two products, handbags and the sport bags. The company uses a direct or variable costing system, which is the standard costing system, and there were no opening or opening inventory on hand on the 1st of April 2014. And I like the fact that there was no opening inventory. And we sometimes get to be required to do the income statement using the direct costing system. And this was mostly done at a secondary level. But in the advanced diploma level, lecturers, they can advance the level of this question and do an integration where you are given more information and also be required to calculate the income statement using the absorption or the standard or the marginal costing. The following information relates to the 6-month period that ended 30th of September 2014. Now remember, the accounting period begins on the 1st of April, which is April, May, June, July, August, September. That is why end of September is the first 6 months of the year. We are provided with the information for the 6 month, which is the sales and the variable data provided to us, and it is specifically for the two bags that the company is producing and selling. We have the number of bags that were manufactured and sold. The company budgeted to manufacture and sell 1,000 handbags and 250 sport bags. Now let us stop there. In the previous question, or the Dazzle Ltd. was strictly required to calculate the break-even point based on the standard product mix. We always use standard product mix or budgeted product mix. Now in this case, what do? We look for the factors that fit in the number of the 1,000 units that the company budgeted to manufacture, and the number that fit in that 250 that the company budgeted to manufacture for both of the products. And we definitely know that 250 goes 4 times to 1,000. That means we don't need to be wasting time. We say 250 goes to 250 once. 250 goes to 1,000. It is 4 times. That means now our sales mix, which I normally call it the sales mix. Now our sales mix, it is 4:1. That means for every unit that we produce, 4 units of handbags, we produce 1 unit of the sport bag. Or for every 4 units that we sell for product handbags, we produce 4 units of product sport bag. 4:1 in terms of sales and also in terms of production. 4:1 in terms of sales and in terms of production. Now let me say product mix. Production mix, we have handbags and we also have sport bags. Our production mix is 4:1, or a product ratio or sales ratio. And that one is done. I've shown the calculation on the site. Then now we go to the next one. We have actual sales, which is 900 and 300 units. Now we need to take the fact that we know that we're supposed to produce and sell 4 units of handbags and produce 1 unit and sell for every 4 units of the handbag of that of a sport bag. 1 unit of the sport bag for every 4 units, or 4 units of the handbag for every 1 unit of the sport bag. So now if that is the case, we need to look at the actual information. This information will be useful in the future when we do the sales margin mix variance. Now we have the actual, which is 900 is to 300. Now if we look at this, we need to look at we need to check if did we meet the standard mix in the actual production and sales. We need to check if did we maintain the standard mix in the actual production and sales. In other words, if we actually produced 900 units of the handbag and 300 units of the sport bag, is this 900 is to 300 in the same ratio of 4:1, which we calculated on standard, or we anticipated on standard. Now let us look at that. We say 900, or we can just eliminate the two zeros and eliminate those two zeros. We are left with 9:3. 3 does go to 3 once, and 3 does go to 9 3 times. We can see that the actual product mix was not the same as the standard product mix, meaning it was less for product handbag, but it was still 1 for the sport bag, although it was not maintained, because it said for every 4 it should be 1 unit, but now it said for every 3 it became 1. So now it is very important to highlight that we did not maintain the standard mix in terms of the production and the sales. And if we did not maintain the standard mix, therefore now we need to say how many units did we actually produce and sell. 1,200. Therefore now we need to calculate the standard mix based on actual production. When now we say we produced 1,200 units, but how much was it supposed, how many units were supposed to be the number of units for the handbag if the ratio of 4:1 was maintained out of that total of 1,200. In other words, we say 1,200 times by 4 divided by 5. In other words, we are saying this was supposed to be in the ratio of 960, then you can say minus 1,200, but I'll just also show you that 240. This was supposed to be 960 is to 240 in terms of the actual production and sales. Our actual production and sales was supposed to be 960 is to 240 in order for us to maintain our standard mix that were stipulated before. So now in other words, it will be 1 divided by 5 times by 1,200. That will give us 240. And you can see that if you say 960 divided by 240, we get 960 divided by 240, we get 4:1. So we can say that if we had manufactured 960 and sold 960 for the handbags and produced 240 and sold 240 for the sport bags, we should have maintained our standard product mix. But in this case, we did not maintain our standard product mix. That means now our sales margin mix variance will be either favorable or unfavorable depending to the situation, but there will be a variance with a positive or a negative number. So now when you do the sales variance, we need to say how many units were actually produced. How many units? We'll say the unit that we actually produced, it was 900 for the first product, and for the second product it was 300. Then you say minus the standard mix being 960 and 240, meaning we are saying we produced 900 for handbags instead of 960. Then for the second one, we produced 300 instead of 240, because the 960 and the 240 is what was supposed to be the production and sales based on our standard product mix in terms of production and sales. For every 4 units that we produce for handbag, we're supposed to produce 1 unit of the, for every 4 units of handbag we produce, we're supposed to produce 1 unit of the sport bag. And for every 4 units of the handbag that we sell, we're supposed to sell 1 unit of the sport bag. But that was not maintained. So we compare what actually happened, we produced and sold 900 and produced and sold 300. What was supposed to be is 960 and 240. So we compare the two, then we multiply the two with the standard standard contribution per unit. So that is already the sales mix variance that I'm already doing now. So let us continue so that we gather all the other information necessary. Standard selling price per bag, it is 430 and 560. That is the standard selling price, which will help us in the calculation of the standard contribution to be multiplied in the calculation of the sales margin mix variance. Our actual total sales value, meaning the sales revenue was 405,000 rands and 145,000 rands 800. That is the actual revenue we received to sell the 900 units and the 300 units that we have. Then after we have our standard variable manufacturing cost per bag is 180 and 200. This is our variable cost. Very important to highlight that it is variable, because we need to say sales minus the variable cost and the 550 minus the variable cost of 200. Then after we come to the actual material that was purchased and used, we purchased material by the value of 551,840 and 18,240. But the requirement or the cost per meter, meaning the cost we incurred per meter, remember this is actual purchase, the cost we incurred per meter was 32. So now if we say the actual total purchase cost divided by the price per meter, it will give us the total meter that we purchased in order to manufacture the 900 units of the handbags. 51,840 divide by 32, we get 1,620 meters. 1,620 meters that we bought. We bought 1,620 meters in order to produce 900 units of the handbags. I want to highlight that. Then we have 18,240 divided by 32. Then we bought 570 meters of material for the sport bags in order for us to manufacture 800 units of the sport bag. Now, I don't want to go further than that in terms of the details. We'll get that one later on, some of the information that is necessary for the material per unit. Budgeted variable, take note of the variable cost and also that of the fixed. This is variable and this was variable. Remember, when we're calculating our contribution, we need to know what is variable, either variable production related or variable non-production related, because the selling cost has nothing to do with the production, but as long as it is variable, we need to take it into account in the calculation of the contribution per unit. So now our budgeted variable selling cost, it is 12,000 rands, and you can say that is the total. This was per bag, it was the cost per bag. This was per bag, selling price was the cost, was the selling price per bag. It was clearly stipulated, but all other figures are not per unit. So this is the mixture of the information. Others are in total, others are per unit. So now we have 12,000, which is budgeted. So now we need to say how many units did we budget to produce and sell. We budgeted to produce 1,000 units. We must divide that by the budgeted selling cost, and then you say divide the selling cost by 1,000 units. That means we can see it very clearly that we get 12 rand per unit. So we have 12,000 divided by 1,000. That means the budgeted selling cost, which is variable, is 12 rand per unit. Then for the second one, we divide by the number of units that we budgeted to produce and to sell, which is 250. So we divide by 250. Remember, once again, we can budget a certain number of units to be produced and sell less than what we budgeted to produce. Why now there will be the closing inventory. So what we budget to produce is not always the same as what we sell. But in this case, they said number of bags to be produced and sold, meaning what we budget to manufacture, we also budget to sell all of it, and we don't want any closing inventory at the end of the period. So now we go there and we say 2,375 divided by 250. This is 9 rand 50 cents. So now our budgeted selling cost for the spot bags, it is 950 per unit. So that is also another variable cost. So now when you're calculating our contribution, which is the selling price minus the variable manufacturing cost, minus the variable selling cost of 12 rand and 950, it will give us the contribution. And allow me to do that calculation because it will be needed in the future. So now we are calculating the contribution per unit. These are just the workings, contribution per unit for the handbags, and also for the sport bags. We have our selling price. Our selling price, it is 430, and our selling price, it is 560, if my memory still serves me very well. We have budgeted actual selling price, budgeted selling price, standard selling price per bag 430 and 560. We less our standard variable manufacturing cost, 180 and 200. Standard variable manufacturing overhead cost, which is 180. I want to be very clear. Less variable cost, which is standard variable manufacturing overhead cost. Please write full name, not the abbreviation as I do. Then here we divide by 200. Then after we have our variable selling cost. We have our selling cost, of which our selling cost, it is 12 rand and 9 rand 50. I hope you still remember, we just recorded it lastly. Then very important to put those brackets indicating that this is a negative, but if you said less here, it is not much of a transmesh to indicate the brackets as a negative. That less will have indicated enough. So now we have to say 9 rand 50 plus 200. We get 209, 9 rand 50 cents. Let me check if there's no other variable cost that we need to take into account. There's no other one. It says further, let me read this last sentence. Included in the standard variable manufacturing cost. Remember, this is our standard variable manufacturing cost. So they say it's already included, the amount we're talking about. We don't need to include it or remove it because it is variable. Included in the standard variable manufacturing cost per bag are the following raw material. Standard material cost per bag. So now they are telling us that the direct material cost, which is the raw material cost per bag, is already there inside. So meaning it is both the direct material and the indirect material that is included there. So we don't have to do anything because it is already included. So in other words, we then now have to say 209 rand 50 cents minus 560. This will give us the contribution of 350 rand 50 cents per unit. Then after we say 430 minus, let me first say 180 plus 12, we have 192 minus 430. If we deduct 430, this gives us 238 rands, no cent. Then we get to contribution per unit. We get to our contribution per unit. So now this is our contribution per unit. And I don't want to go further than that. Remember, when we're calculating now our break-even point, because we already know that there is a break-even point. When we're calculating our break-even point, let us just verify that when we're calculating our break-even point, we know that we need to multiply these figures by what we call the product mix. We need to multiply this by product mix or sales mix. Our product mix, it is 4:1. So now we can do that now. Then this will be left with 350.50. Now I'm already in the last requirement. Then here we have 238 times by 4. Then this will give us 952 rands. 952 rands. So now this will be our product mix. Then after we get to our total weighted contribution, and our total weighted contribution will be 952 plus 350.50. I'm saying plus, it is negative because the number, the figures are both negative. 1,302 rand 50 cents. Some students get to be confused. It is 952 plus 350.50. 1,302.50. This is the amount that we are going to use to divide with our fixed cost in order for us to get to the break-even point per batch. Then after we multiply that by the product mix, which is 4:1, then after we multiply that by the selling price to get to the contribution, or so to get to the break-even point sales value. So this info is enough now for what is needed at this stage. Then let us go now to the standard material cost per bag, which is in the last table there. We have our standard raw material cost, which is 54 rand per bag and 74 rand per bag. Now we need to say how many meters of material are required to complete 1 unit of the handbag, and how many meters of the sport bag are required to complete 1 unit of the sport bag. How do we do that? So we say 54 rand divided by the cost per meter. So that will be 54 divided by 36. So now, in other words, we require 1.5 meters to complete 1 unit of the handbag. 1.5 meters of the raw material to complete 1 unit of the handbag, not sport bag. Then 74 divided by 36, it gives us 2. In other words, we need 2 meters to complete 1 unit of the sport bag. So that one is also sorted out. This will help us later on in the future. So we are given with the last information, number 2, which is the fixed cost, where they say rental on the administrative building is very unavoidable for the next 5 years, obviously because of the contract, which is 13.5 per month is our rent, which is fixed every month for the next contractual agreement that is binding for the next 5 years. Now we have another fixed cost, which is budgeted fixed manufacturing cost amounting to 65,000 rands in total for the first 6 months of the year, and used to calculate the budget company-wide and recovery rate based on the product units, unavoidable unless the company no longer manufacture any of the products. If they still, then we'll be incurring them. However, we need to multiply this by 6 because we are provided to do our calculation for a period of 6 months. Then that will be 13,500. We multiply this by 6, it gives us 81,000 rands. That is what will be the rental fixed cost in total for a 6-month period. With that information, we can now go and delve straight to what is required. Requirement first is to calculate the sales margin mix variance for the 6-month period, and I said that the sales mix variance, we focus mainly on the actual units, vice versa the units that were supposed to be in terms of the product mix. So now what do? We say we have 2 products, and our products, it is the handbags. We have the handbags and the sport bags, and this is the sales margin mix variance. This is the sales margin mix variance, and under the sales margin mix variance, we have to say actual sales, vice versa actual sales based on standard mix. Actual sales, vice versa actual sales volume based on budgeted mix, because our budgeted mix was 4:1. So now what do we say? We say our actual sales are 900 for the first product and they are 300 for the second product. Then we said the total of this, it is 1,200, and we need to compare this with the allocation of our budgeted product mix, which is 4:1. So now we need to apportion the actual and say how much was supposed to be produced. If in total we produced 1.2, how much was supposed to be produced for the handbags if we apply our standard product mix. So now, in other words, as I said before, that it will be 1,200 times by 4 divided by 5. That is the ratio of 4:1. We're supposed to have produced 960 of the handbags, and we're supposed to have produced 240 of them as sport bags, which is 1,200 times by 1 divided by 5. We are allocating our actual sales using our standard product mix. That is what you do in the sales margin mix variance. Then you multiply this by the standard contribution. You multiply this by the standard contribution. And our standard contribution per unit, it is 238 and 350.50. That is our contribution on standard per unit. So now those are the figure that we use. You multiply by 238 and you multiply by 350.50. Therefore, now this will give us what you call the variance for this question, the sales mix variance. Then after sales margin mix variance, 900 is what actually take place. 960 is what was supposed to be. So we produced and sold less than what was supposed to be. So now we multiply this by 238. That variance becomes unfavorable because we produced and sold less than what was supposed to be. Remember, I'm saying supposed to be based on our standard product mix, where we say for every 4 products we produce for the handbags, we're supposed to produce and sell 1 product of the sport bag. But in actual fact, this did not maintain that, and we have tested that it gave us 3:1. So now, in other words, we continue and we say I did 900 minus 1,000. Multiply this by 238. 23,800 is our variance. 23,800, which is unfavorable variance. Adverse variance, the second one will be favorable. We produced and sell 300 instead of 240, meaning we produced more, times by 350.50 and sold more. So this will be favorable on our side. This will be favorable on our side because there will be more revenue on our side. This will be 21,030. This is a favorable variance. Then we say minus 23,800. Then it gives us not 23,800, not 23,800. I just check the 23,800 seem to be not correct. We said 238. Oh wait, 900 minus 1,000, not 1,000, 900 minus 960. Yes, I said 1,000 times by 238. Then that is 14,250. That is 14,250. Then we say minus 21,030. We get a total of 6,750. The difference between the two is a favorable variance. This is the total variance for the 2 product. Favorable variance for the 2 product. Sorry for that error mistake for the first one. I just set 1,000 in my mind now, which was budgeted, of which we don't do the budgeted. Then that was Roman figure 1. Then we go to Roman figure 2. Roman figure 2, we are calculating the sales volume variance. Sales volume variance, sales margin volume variance. Sales margin volume variance. Volume is budget minus actual. Sales margin volume variance. we have the handbag once again. Then we have the sport bags. We say budget minus actual. We compare the budget with the actual, or the actual with the budget. In fact, we say actual minus the budgeted. Preferable to start with the actual in this case, so that you know automatically when the variance is negative, it will be unfavorable. Our actual production and sales, it is 900 and 300 for the second product, but we budgeted to produce and sell 1000, then and 250. Even if you start with any one, but as long you know, then you multiply this by 238, you multiply this by the standard contribution once again, 350.50. In the previous one, I want to highlight the fact that in the previous variance, we look at the actual units, vice versa, actual units or actual sales units using or based on standard product mix. So that one is how it is, but this one, it is actual vice versa budget. Then after we look for the variance that we have in here, if is it favorable or not. 900 is what was produced and sold instead of 1000, then obviously this will be unfavorable. Then it is 23,800. It is the error that I did in the previous list. This is adverse variance. For the second one, it is 300 minus 250. Multiply this by 350.50. We produced and sold more than we supposed to, then obviously that will be more money, 17,510.25. This is a favorable variance. Then we say minus 23,800. Then it gives us 6,275. 6,275. So we draw a line here, then this will give us the total. This will give us the total variance, which is a total of the 6,000. A total of the 6,275. So that is our sales margin volume variance that we are talking about. Then we go to the third part of our variance, Roman figure 3, which is material price. Material price variance, and the material price variance is for the two inventory that we have. It is the handbags, or the two products that we have, and the sport bags. It says standard price minus actual price times by actual quantity that we purchased. Standard price minus actual price times by standard quantity that we purchased. And the standard quantity that we purchased, I think we know them. Standard quantity that we purchased, we had 1,200 meters, and we had 570 meters that we purchased. I hope you still remember those figures. Let us check where they're coming from. Actual material purchased. Actual material purchased. We did not say that we had the figures 51,840 and the price per meter. So we said the total price divided by the price per meter. It gave us 1,620. Sorry, 1,620, not 1,200. It is 1,620. For the first product. The second one, I think I must have been correct, the 570. The 570 meters, 1,620 meters and 570, which was 18,240 divided by 32 rand per meter. So now let us look at the standard material price. There we have our standard material cost per bag, which is 36 rand for the handbag and for the sport bag. So that is very easy. We have 36 rand and we have 36 rand. How much was the actual price per meter? The actual purchase price per meter is 32 rand for both of the products. So it is 32 rand per meter, so we don't hesitate, we write the same amount, which is 32 rand for both of the products. Then after this will give us our variance being favorable or unfavorable. It will obviously be favorable for both of them. 36 minus 32, it is 4 times 1620. It gives us 6480, which is our material 6480, and this variance is very favorable. Then for the second one, 4 times by 570, we get 2280, that is favorable variance. We add the two, it gives plus 6840, 6408, 6480. It is a total of 8760, and this is our favorable variance. So now this will be the total variance for the material price that is favorable. Then now we go to the next requirement. The next requirement is that of the calculation of the break-even point sales value, and I've done all the calculations already. Now all I need is the fixed cost of 81,000 rands plus 65,000 rands, and I divide that by the contribution, which I've already calculated. My contribution after taking into account if you remember, after taking into account the product mix, I've calculated the contribution there. Remember, whenever there are two products, you always have to multiply your contribution by the product mix for each product and add the two figures in order to get to this total average or weighted average contribution per, for the company. It's 1,302.50. Sorry. So we are calculating now our number C, which is break-even point in value, break-even point sales value. But we start with the units, obviously. It is fixed cost divided by contribution. Our fixed cost are 81,000 rands plus 65,000 rands. We divide that by a total of 1,302 rand. 1,302 rand 50 cents. 1,302 rand 50 cents. Where is the 81,000 65,000 coming from? We said 13.5 times by 6. We said 13.5 times by 6. Why do you multiply by 6? Because the break-even point is for a period of 6 months. But the 65,000 was already for 6 months. So that's why we add the two for 6 months. Then after we say 81,000 rands plus 65,000 rands, it gives us the total fixed cost of 146,000 rands. We divide it by 1,302 rand 50 cents. Obviously, R will cancel R. The amount we are going to get will definitely be 112.092 whatsoever. The amount that we get will definitely be in units, not in rands. And this is batch. This is in units of batches. Now that we have done with this, we know this is 113. We need to know the break-even point per product now, which is the handbags, and the sport bags. The handbags and the sport bags. We say 113 times by 4. We multiply always by the product mix or the sales mix or the product ratio for that product, which was 4 for the handbags. Then we say 113 multiplied by 1 for the sport bags because it was 1. Then this will give us 113. Then we say 113 times by 4. It will give us 452 units. Now that we have 452 units and 113 units, we need to multiply this by the selling price. Why? Because the requirement was to calculate the break-even point sales value. So we need to multiply by the selling price so that we get to the value or at the sales value at the break-even point. We budgeted to sell 430 at 430 and 560. So we multiply here by 430 and we multiply here by 560. Then we multiply here by 430. We get to 19,000 or 194,360. 194,360. Second one is 113 times by 560. This gives us 63,280. 63,280. The total will be plus 194,360. The total will be 257,640. This will be the revenue the company will receive at the break-even point. This is the revenue the company will receive at the break-even point. So this is our total. It is very important to say sales value there. Say sales value there. You write the sales value. Now we continue to the last part of this requirement. Last part of this requirement or of this question was to calculate and I want just to highlight the last part. If this was a requirement to calculate the contribution at the break-even point, if it was saying contribution at the break-even point, we'll have to multiply by the contribution. What is our contribution? Our contribution, we have seen it. Our contribution, we have seen it to be 238 and 350.50. So if the requirement was to calculate the contribution at the break-even point, then when we reach here, I want to show you, when we reach here, we'll have to then multiply by the contribution, not the selling price, if the requirement is to calculate the contribution at the break-even point. And if the requirement was to calculate break-even units, we'll just have to stop here and don't do anything. But because we are required to calculate the sales value at the break-even point, or break-even point sales value, therefore now we need to multiply by the selling price. Then now we go to the second part of the last requirement. Second part of the last requirement, we are told fixed costs have remained the same, but we are told that we are to calculate the break-even sales quantity, which is units, for the handbags only for the 6-month period, once again based on the following assumption that by the end of March 2014, the supply of the sport bag line the sport bag product line was discontinued and the standard material purchase price per meter was adjusted by 10%. So the material cost per meter decreased by 10%. So now that is one thing that we need to adjust in terms of our contribution. So let us do our adjustment to our contribution for the handbag only. Contribution for the handbag. The selling price, it is still the same, 430. Our variable cost, what do we have? We have we have our, okay, it will take me time. We have our standard, just want to use the right term. We have our standard material cost per bag, which will change. Standard material cost per bag. Then after we have our variable selling cost. Our variable selling cost has not changed, still remain at 12 Rand. But this is the one that will change. Now let us see how that will change. And I just want to use a very shortcut approach. Now we are told that there will be a decrease by 10% in terms of the material per meter. In terms of the material per meter, there will be a change. And our material required per meter, it is 1.5 and 2 meter. Remember, this is discontinued. So what will decrease? It is the material, which is this material per meter. And we know that this 54 rand is included in there. So we need to remove this 54 rand because this 54 rand will decrease. Remember, the cost per meter on standard remain the same, but the requirement per meter will change. So now let us say 180 minus 54, so that we deal with the separate figure. 180 minus 54, we are left with 126. 126 remained the same. So now in terms of our standard material cost, we still have 126 there remaining the same. We just need to add the adjusted part of that 54 rand. So now how do we do the adjustment? Remember, 1.5 must decrease by 10%, so it will be 1.5 times by 0.90. We reduce it by 10%, and I'm not going to be explaining all of that. You can decrease any number by 10% in any way that you want to do. So it will be 1.5 times by 0.90, reducing it by 10%. We are left with 1.35. 1.35 times by 36 rand per meter times by 36 rand per meter, it gives us 48.50, no longer 54. So now it will be 48 rand 60 cents per unit. Now the standard raw material per bag, 48 rand 60 cents. So now we come and we add that 48 rand 60 cents here. Then after adding 48 rand 60 cents, we add the 126 that remain the same. We get 174.60. So we have 174.60. Then we add the two, 174.60, 174. I don't know why this calculator is doing 174.60. How did I maximize your calculator? 174.50. Or I'm just trying to minimize this calculator. Then we 174.60, 174.60 plus 12, we get 186.80. 186.80. Let me just recheck this calculator. Yes. Then we have 430 minus 186.80. It gives us 243 rand 20 cents. We get 246 rand 20 cents. 243 rand 20 cents. 243 rand 20 cents. So this will be our contribution. This will be our contribution. Now that this is our contribution, then now we can use this contribution to divide to our fixed cost. We can use this contribution to divide to our fixed cost. Now let us go straight and divide to our fixed cost. Remember, we only have one product. If there's one product, we don't multiply by the contribution. The product mix. This is the contribution per unit. So we don't multiply by that 4 because we only have one product. Only when you have two products, you multiply. So now our break-even point in units or quantity will be fixed cost of 146,000 rands divided by 243 rand 20 cents. So now that will be the requirement that they required us to do. It will be 146,000 rands divided by 243 rand 20 cents. Then it will give us a total of 600 handbags. 600 handbags. Sorry, 600 handbags. So this is exactly what was required. The rounding off, it can be 6.1 because we don't produce half of the product. It is normally not an argument that much. There's normally no penalty on that. Sorry. So with that, guys, I think I covered all that was necessary in this question and emphasized everything that was important. With those words, thank you very much.